Hi friends, today let us start learning a new unit called investment decisions. Now, what is the meaning of investment decisions? It is very clear. It is the decisions to be taken with respect to an investment to be made. Now, before we go to the conceptual and technical terms, let us firstly understand what will be the decisions for investment to be made or for investment to be taken up. Let us say, for example, Reliance Industries, it has expanded all over the country. Now it wants to also set up a factory in Madhya Pradesh. Now, it requires say about 100-acre land, which costs say about 500 crores. Now this is the first investment, this is the initial investment. Now after that, it has to construct the building, construct the factory, entire factory. Say that takes about 6 months to 1 year. Then it has to purchase lot of plant and machinery that has to be installed in the factory. Like this, there is so much of investment, a substantial expenditure to be made to construct this factory. Now, once the factory is ready, once all the equipment is set up, then what happens? The company starts generating revenue from the products which are made out of the factory. Now, the moment Reliance Industries thinks of whether it is a viable investment to set up this factory or not. Now, how will it decide? Very simple. There are two sides of coin. One is the cost factor. Two is the return. So, we all know that whenever a decision has to be taken, the simple funda is always the benefit has to be more than cost. Now, when is the benefit happening? We just said it is investing today, and after 6 months or 1 year, the construction of the factory will be over. Even then we will not get any inflow. Then after that, machines have to be installed. That may take about 3 to 4 months. Then the people have to be recruited. Only then they get the raw material, they have to make the products and they have to sell the products, and this takes a very long time. Maybe it takes about 1.5 to 2 years to start generating revenue. And even then, even after that also parallelly, the company may have to incur on expenditure like repairs and replacements. Therefore, say in a span of 5 years or 10 years, there are so many outflows in the project, and there are also inflows in the project which generate after a period of time. Now, how will the company decide whether it is viable or not is what we will learn in this chapter. That is, say we have some initial cash outflows and we have some corresponding future cash outflows, we have some future cash inflows. Now, having learnt the concept of time value of money, we will bring down all these inflows and outflows to today, and then we will decide whether it is a viable option or not. For that, we will have to learn various techniques that we will go gradually and then understand. Therefore, precisely what is the meaning of an investment decision or a capital budgeting decision? That is, when you want to make an investment, whatever the capital is available with the company, it has to budget the capital properly and ensure it is generating a return which is over and above the cost. So, in the example what we just said, the company has to decide whether the benefit generated out of all the sales made and whether the profit finally what the company is making is over and above all the expenditure it is incurring, all the cost it is incurring. Therefore, this is what precisely we will understand whether should we invest or not. How is the capital budgeting made to decide to take an investment? Now friends, let's understand what is the importance of learning this chapter of capital budgeting and what is the purpose of learning capital budgeting. Now, let's go back to the example, that is Reliance Industries wants to set up factory in a 100-acre land for which the cost of the project is about 500 crores. Now, the moment we think of this example, what first comes into our mind? 500 crores, friends. It is not hundreds, thousands and lakhs. It's 500 crores. Therefore, for a capital budgeting decision to be made, the expenditure is a substantial expenditure. It's a huge amount involved. Therefore, if we do not carefully evaluate and take a proper decision, then definitely it's going to become very, very dangerous for the company. And hence, as huge amounts or as substantial expenditure is involved, it is very, very crucial to know the techniques and to take a decision very, very carefully. This is the first point. The first reason is expenditure being substantial. The second one, we said today we are making the investment in the factory. That is, today we purchase the land or the company purchased the land, it has to construct the factory. It will take about 6 months to 1 year. Then the company will purchase machinery and install that machinery and plant, for which again we said it will take 3 to 5 more months time. And then the company purchases the raw material, it has to make the products and then again sell. That may again take 6 more months. And then we said the company generates revenue. Now that is also, we're not talking about 1 year, 2 years, it may go up to 5 years, 10 years or even 15 years. Therefore, capital budgeting decisions are generally concerned with long time periods. Therefore, we should carefully evaluate all those cash flows. We said the cash inflows, that is in the form of revenue, they will be generated over a period of time. Also, we said periodically we may have to spend some more money for the purpose of repairs and replacements and all this stuff. And hence, throughout the period of the project, throughout the tenure of the project, there are so many inflows and there are so many outflows, and precisely it is a very, very long term decision to be taken. It is not a very small term decision, it is a very long term decision, and hence the capital budgeting technique should be properly used and the project has to be evaluated. So the second reason why we said capital budgeting decisions are important is because of the long term tenure of the project or the decision to be taken. Then comes the next reason. Now tell me friends, once we purchase the land, once we start constructing the factory, say for example after 6 months or 9 months, do you think suddenly if you have a doubt whether this products will be workable financially or not, do you think you can very easily come back from the project? You can withdraw the idea of going ahead? Definitely no. Now it already involved so much of expenditure and it already involved so much of procedure. Now it is not that easy to reverse the decision once taken. That is the irreversibility of a decision to be taken, and that is why even before deciding itself, the firm or the company has to carefully analyze all the inflows, all the outflows, all the obstacles, all the obligations, all the market scenarios, and then only the decision has to be taken. Therefore, irreversibility is one another reason for which we should be extremely careful in analyzing and making a capital budgeting decision. Now comes the last reason and one of the most important reasons, that is complex situations. Friends, we said we have to make a decision based on future cash flows. Now, do we exactly know what will be the cash flows? Definitely no. We will take some probable numbers. We said, say for example, after 6 months, we will complete the construction. What if the 6 months takes 1 year? We said after 1 year, we will have to install the machinery. Now, what if that installation of machinery happens after 1.5 years? And we said we will generate some revenue. Now, what if the revenue what we wanted to generate is not meeting with what is actually generating? Therefore, we have to be extremely careful in analyzing the numbers, be it inflows, be it outflows. Both are very, very important. Therefore, the cash flows, the relevant cash flows which we use or which we take or consider for the purpose of capital budgeting decisions, they are not actuals, they are probable or just considered or evaluated numbers. Therefore, we have to be careful in terms of understanding and analyzing and adopting the right numbers, be it inflows or outflows, and there are so many complex decisions involved in the process for which the company has to be prepared. Therefore, as there are so many complex situations and decisions to be taken in the process, capital budgeting decisions are very, very crucial and important. Let's just recap once as to what are the 4 important reasons. The first one we said, substantial expenditure. There's a huge amount involved in making a decision. Therefore, we have to be very careful. The second reason we said is the tenure. The decisions which we take are not concerned with a very short span. They are concerned with 5 years, 10 years, 15 years, a very, very long period. Therefore, the long term is the second reason. The third reason is irreversibility. Once a decision is taken, once the procedure starts, then it is very, very difficult and dangerous to withdraw or to reverse the decision, and it is also not economically viable to reverse a decision. That is, irreversibility is the third reason, and the last reason is complex situations, that is uncertainties in predicting whether cash inflows or cash outflows. Now friends, let's move ahead into the next aspect, that is the steps involved in the process of capital budgeting decisions. Now, before we name all the steps, let us once go back to our example, that is Reliance Industries setting up a factory in a 100-acre land worth 500 crores. Now let's go back to this example and then see what can be the steps, and then we will come back to the technical names and terms of the steps. Now, the first thing what you are supposed to do whether this company has to take up a decision or not, what is the first thing we do? We plan. We plan as to whether is there any opportunity to purchase this land, to construct that. Now, where are we supposed to purchase the land, in which area, how far is it from the city, what is the accessibility to that place is one part. Then we'll have to plan what is the capital, what is the amount required to first purchase the land and then to construct the building and then to set up all the machinery. Therefore, anything for that matter definitely needs to have a basic planning. Therefore, the first step in the process of capital budgeting is planning, as to have an idea with regards to the investment opportunities. Then also regarding what is the market demand for this product and all that stuff. Now, the next step, that is evaluation. Now, we said in the example, today we will invest the amount, after 1 year some more amount, after 2 years some more amount, and again after 1.5 or 2 years we will keep generating revenue. Now, how do we decide whether the amount what we are getting, the inflows, is it better than compared to that of the outflows? Now, there are some techniques in capital budgeting which are called capital budgeting techniques. These techniques are used to evaluate a project or evaluate a proposal. There are again two types of techniques. One are called traditional techniques, the other are called modern techniques. The basic difference between these traditional and modern techniques is the traditional techniques do not consider time value of money, whereas the modern techniques, they consider the time value of money. Therefore, the second step is evaluation of a proposal. So, we said the first step is planning and the second step is evaluation. All these cash flows, all these cash outflows, we will use some capital budgeting techniques and then evaluate whether this proposal is a viable proposal or not. Now, this is the second step. What is the third step? Selection. So, using different techniques, we said we will check out whether which is better. Now, finally, based on the numbers what we calculate, we are supposed to decide. Say for example, this factory wants to purchase a big asset, a big machinery. Now, there will be a benefit out of machinery A, there will be some other benefit out of machinery B, some other for machinery C. Now, is A better or B better or C better, or is it viable better to go for both A and B and to avoid C? Like that, the company has to decide based on the evaluation techniques as to what are the assets in which the company has to invest. So, this stage is called as selection. Now, till here friends, the planning, the evaluation and the selection, till these three steps, they are all on paper steps. Now comes the fourth step in the process, that is the practical step, which is called implementation. We thought of having some initial amount. Now later on we thought we'll have to invest some more amount. Now all these we have some evaluated figures, we have some projected figures, but now in the step of implementation we will get into the actuals. Whatever budgets we prepared, whatever plans we had, whatever estimates we made, are they actually meeting with the actual expenditures we are incurring, actual revenue we are generating? We said after 6 months, after 1 year. Now are we actually in line with what we thought and what we wrote? Is what we will check, is what we will see in the step of implementation. Now immediately after implementation, as we go ahead, then comes control. What control? Say for example, we thought we will have to incur about 50 crores for the machinery. Now is that 50 crores what we thought on paper, is it actually being spent, or is it being a little more than for what we thought? We thought we will generate a revenue of say some 10 crores monthly. Now are we earning 10 crores? Are we falling behind? So this comparison of the theoretical as well as the practical aspect is what we see in the step called control. The control can be for cost, or the control can also be for the performance. As we said, we will generate some revenue. Now what is that we expected to generate and what is that we are actually generating? This is called as a performance comparison. Like this we will have to control. And the last step that comes here is review. Say we purchased the land, we purchased the machinery, we recruited people, we started generating, we started selling the products and we started generating revenue. Now in this entire process, what are the flaws or what are the areas in which we did not compute properly, or what are the areas in which we made a mistake, and how to rectify those mistakes so that the future decisions are even more carefully taken. Now friends, we thought of all these things step by step. Let us just name all of them at one shot. The first one we said is planning, then we said evaluation using some capital budgeting techniques, then selection based on evaluation, then implementation based on selection, then control for the implementation, and lastly review for all the actions. So these are the steps involved in the process of capital budgeting decisions. Let's move to the next area, that is the types of capital investment decisions. The capital investment decisions are classified basically into two types. The first one is on the basis of firm's existence, the second one on the basis of the decision to be taken. Let's see firstly what are the types of decisions on the basis of firm's existence. That is, a firm already exists, and then what will be the decisions to be taken on the basis of the existence of a firm. Let's go back to our example that Reliance Industries set up a factory, all that story. Now, say assume it's been almost 5 years that the industry has been set up. Let's say after 5 years, what can be the situations which can happen? The first thing we will say, maybe one of the asset or a machinery has to be replaced. Obviously, yes. Why? Because the economical life of the asset or the machinery must have been over. Say the life is say 3 years or 4 years, whatever. When the economic life of the machinery comes to an end, the immediate decision what is supposed to be taken is replacement decision. Now, should we replace this asset or not? Now, what happens by replacing? Definitely a new asset comes into the picture. This asset will be sold and there will be an incremental cash flow when compared to this asset. What will be a higher revenue I can get out of it? Now, even when I have to purchase that, I can sell this. Therefore, in my initial cash outflow, there will be a reduction. Like this, there are so many factors to be considered. Such a decision to be taken for replacement of an asset is called as replacement decision. In similar lines, there can also be a modernization decision. Now, this replacement and modernization, they go a little hand in hand. But what is the technical difference? Replacement happens when generally the economic life of the machinery gets over. Modernization happens when there is a technological updation happening. Say for example, the company is using a semi-automatic machine. Suddenly in the market, a fully automatic machine has been introduced. Then by upgrading from a semi-automatic to fully automatic, definitely there may be a huge saving in cost. There may be a speed up of production. There may be a higher revenue possible, higher demand. So all these things considered, then we can say such a decision to be taken with respect to upgradation or replacing the asset for the purpose of updation can be called as modernization decision. This is the first part. This is the first type of decision, that is replacement and modernization decision. The next decision in this existence of a firm is expansion decision. What is expansion? Again, we'll go back to the same example. Let us say 5 years has been over and the company is doing really well. Now the company wants to expand. Now why will generally expansion happen? When the company is running efficiently and when there's a possibility of growth, when there's a high demand in the market for the products of the company, there is a possibility of expansion. And also where the demands are high and when the company is not able to produce products or even when the production capacity is not sufficient, then there is a possibility of expansion. Therefore, what should be the further investment to be made to meet the market demand and to increase the production capacity is called the expansion decision. In the same lines, the next one will be diversification. But what is new in diversification? Expansion refers to expanding or increasing the existing capacity, whereas diversification means entering into a new stream altogether. Say for example, Reliance Industries now wants to get into jewelry market. Now it will make a decision whether if it enters into jewelry market, what are the possibilities and should it enter? Now if it enters, what are the corresponding cash inflows, cash outflows? So any decision to be taken to enter into a new product line or into a new market is called as diversification decision. So based on the firm's existence, we have seen three types of decisions. 1, replacement and modernization decision. 2, expansion decision. And 3, diversification decision. Now that we have seen the decisions on the basis of firm's existence, let us now see the different types of decisions on the basis of situation. The first one we will call it as mutually exclusive decisions. Now, what is the meaning of mutually exclusive? Basically in common language, in English language, mutually exclusive means there is no connection between one decision and the other decision. Say for example, we want to purchase a television. Now you may want to purchase either a Sony television or Akai television or Samsung television. Now if I say you have decided to purchase Sony, that means you are not going to purchase a Samsung television or any other company television. That is, if you are making one decision with respect to one asset or one project, then automatically the other options which have been considered will not have any influence. That is, they are set to be rejected. Only one out of the lot will be taken up in the case of mutually exclusive. That is, selection of one means automatic rejection of the rest. This is about mutually exclusive decisions. The second type of decisions is accept reject decisions for independent projects. What is the meaning of accept reject? Friends, suppose you want to invest in a machinery. The first question what comes again based on the example what you have taken, should I invest or not? How do we decide? We said we have some different techniques. Based on those techniques which the company follows, we will say whether this is a viable option or not. If you say yes, you want to take it up, you say it is an accept decision. If you do not want to take it up, it is called as a rejection decision. Now in this, if you want to go ahead with more than one projects, Say for example, you have a 10 crore budget with you and there are some 4-5 proposals. Say one proposal is 3 crores, the other proposal is 4 crores, the other proposal is 5 crores, and there are 2 more proposals like this. Now 3 plus 4, 7 plus 5 comes to be 12 crores, which is over and above the budget. Now, of all the proposals you have, according to the decision evaluation method or the evaluation technique, which are the best proposals you want to choose? You will pick them up. Then you will see whether they are in your purview of expenditure or capital budget. That is, if you take up a 3 crore project and a 5 crore project, it is fine. If you want to take up a 4 crore project and 5 crore, it is fine because they are less than 10 crores. Now, if you want to take up one a 4 crore, the other a 7 crore project, it is not possible. Again, it may be possible based on the type of the projects or the nature of the projects, whether they are divisible or indivisible. Therefore, the second type of decisions what we are supposed to take are accept, reject decisions. Therefore, in the first case of decision, that is mutually exclusive decisions, we said acceptance of one will automatically result in rejection of the other. Whereas in the second type of decision, that is accept, reject decisions, in the case of independent projects, acceptance of one does not directly indicate the rejection of the other. It depends upon the situation. Last type of decision, that is called contingent decision, that is interlinked decision. There is a condition for a decision. For example, the factory example what we thought, let us go back to the same one. Suppose the factory is say about 100 kilometers away from the city, then in such case there has to be a roadway developed for that. The employees have to be provided some accommodation. So based on the decision as to where the factory has to be constructed, then based on that there may be some other expenditures also which are interlinked or which are connected to the main expenditure. So such decisions we take are called contingent decisions. So these are broadly 2 types of decisions, one based on the firm's existence and 2 based on the decision situation. Now friends, we have been saying that relevant cash flows are important for capital budgeting decisions, but we never computed or we never understood as to how to compute the relevant cash flows. Let us just see. We know the first step, the first return which comes for investment is sales. Now to generate the sales, we are supposed to incur some costs which are operating costs. Now this operating costs include both variable as well as fixed cost, but we are not including depreciation at this level. Therefore, sales minus operating costs will give us, we can call it either cash flow before depreciation and tax or profit before depreciation and tax. But in more usage is cash flow is the more used term for this stage. Now, from cash flow before depreciation and tax, first we will have to remove the depreciation to arrive at profit before tax, because tax is paid only from this term. If you look at the P&L, we will remove the depreciation to compute the tax part. Therefore, from the cash flow before depreciation and tax, we exclude the depreciation part to arrive at the profit before tax. Now, from this, we remove the tax component to arrive at profit after tax. But friends, we said we require the relevant cash flows. Therefore, we will not stop here, and depreciation though is reduced for the purpose of computation of tax is not a cash outflow. It is a non-cash expense. Hence, to know the actual cash value, we are supposed to add back the depreciation. Therefore, plus, that is, we add back depreciation, and this term is called cash flow after tax or post-tax cash flow. So this is how we compute this post-tax cash flows, and this CFAT or cash flows after tax is called as relevant cash flow for the purpose of capital budgeting decisions. Now friends, let's take the help of a timeline to understand what are the different cash flows involved in a capital budgeting decision. Let's say we have 1, 2, 3, 4 and 5 years. Therefore, so year 0, year 1, year 2, year 3, year 4 and year 5. Now, in year 0, that is today, say, there will be an investment which is called as initial cash flow or initial cash outflow. Then, let us say from year 1 onwards we generate revenue or we generate cash flows. Then, we will have to write CF80, that is the cash flows after tax, which we just saw how to compute. They are the relevant figures for the purpose of taking a capital budgeting decision. So CF81, CF82, CF83, CF84 and CF85. Now these are the cash inflows, whereas the initial cash outflow, what we said, is a cash outflow. Now friends, say in year 2 or in year 3 we may have to incur further cash outflow. 1, further cash outflow 2. So these are cash inflows which are generated at the end of each year, and these are cash outflows, whereas ICO stands for initial cash outflow and FCO stands for further cash outflow. And in the last year of the project, apart from these annual cash inflows, there will be a terminal cash inflow or an inflow which happens in the last year is called as terminal cash inflow. Therefore, plus terminal cash inflow. We don't have to call it with a number because terminal cash inflow is always for the last year. Now, let us see a little deeper way as to what are these items. We said the first item, that is the initial cash outflow, is nothing but the capital investment or the capital expenditure invested today. Then CF80, we said it is the cash flow after tax. That is what we just learned as to how to compute. That is from sales minus operating costs will give us cash flow before depreciation and tax. We will remove depreciation to arrive at PBT to know what is the tax amount. Otherwise, we don't have to remove the depreciation. Because depreciation is a tax deductible expense, only for the purpose of computation of the value of tax, we remove depreciation, and once we arrive at the profit after tax, we again add back the depreciation to arrive at our relevant cash flows, that is CF80. Now, if the CF80 is same for all the years, we will call them as annual cash flows or annual cash inflows. We will simply call CF80. But if sales is different for each year, costs are different for each year, then obviously CF80 for each year will also differ. In such case, we will have to give numbers, that is CF81, CF82 and so on. These are all the cash inflows. And lastly, we said there is something called terminal cash inflow. Now, what is generally terminal cash inflow? The asset which we purchased after 5 years may also have some value. It will have some salvage value, it will have some market value. Now this inflow, the actual inflow which is expected to be generated on sale of the asset, inclusive or including the tax effect, we will call it as the terminal cash inflow.